All right, guys, welcome back to Chapter 2, where we're going to be learning about what truly is accounting. So, we talked about the definition of accounting. It's the process of analyzing, recording, summarizing, interpreting, okay, financial or business transactions. Now, of course, when we learn what or how to understand accounting, we learn it as if it's a new language. With you guys, you guys are pretty kind of familiar with the terminology, right? So when we're learning accounting, we're essentially learning a new type of language that we deal with in business. So in this case, right, to receive is a receivable, to pay is an expense, to owe is a payable, right? Property is considered an asset, an obligation is considered liabilities. Okay. And of course, we looked at the areas of accounting. So what we're expected to know is that we are looking at financial accounting. Okay. So if when we go through each lesson, you're going to notice that there are some terminologies that I want you guys to kind of get used to, such as if I pay something on an account, it means I owe somebody money. Okay. Most cases, if I made a sale, your automatic assumption is that you're going to be receiving money at some given point, right? Especially with sales, right? That's the main core of your business. You're expected to be receiving some form of currency or some form of payment. All right, so that's just a few little key terms here that we're going to be using throughout the next 15 weeks. Okay. Now, first we gotta start off by introducing this, okay? There are a total of 5 accounts, and what accounts are is that they are a means of separating or sorting your transactions based on what kind of level or what kind of type they are. So there are a total of 5 types of accounts. You have your assets, your liabilities, your equity, your revenues, and your expenses. Now, these 5 accounts, there's only 5 and 5 only. There's no more, no less. Okay, there's exactly 5, right? And these are what build the accounting equation, but it also is what is the backbone of most businesses, okay? We got your assets, which usually determine what you own. Your liabilities are going to be determining what you owe. Your equity is going to be the value of your company. Revenues / income, they're interchangeable, usually reflects the money that you generate in the business, and your expenses are going to be the things that cost you in order to operate. Okay? Now, here's one underlying thing that you need to know when you're looking at these types of accounts. They are separated by another bracket. Your permanent accounts are going to be your assets, liabilities, and your equity. What I mean by permanent is that they never close at any given time or period. Okay? What do I mean by that? For example, an asset, right? Your bank account is going to be considered an asset. If you choose to close your bank account at any single given time, what does that mean in a business if you close your bank account?
That you probably close your business?
That you close your business. Exactly. All right, I'm going to give you another example. If you owe people money, right, and you're trying to close out your account, at the end of the day, they're still going to chase after you because you owe them money. So at that point, for liabilities, when you do owe other people money, they're still gonna come after you until you pay your obligation off. Okay? All right, so that's what permanent account. They never close at the end of a given period. Okay. However, your revenues and your expenses, here's some food for thought. They're called temporary accounts because they close at the end of a given period. Now, if let's say we do a month to month type of business, or our accounting period is every month, right? Can you expect your revenues or your income that you generate? Can you expect them to be the same every single month?
No.
No.
No, you can't. Same thing goes with your expenses. Although you have some fixed expenses like your rent expense, that should stay constant, but you're always going to be incurring other expenses, such as maybe this month, right? It's the month of June. There's usually no holidays, so I'm not going to spend money on advertising. But when July rolls around, yes, we should promote sales during 4th of July weekend. So therefore, we need to encounter some advertising expense. So here is a perfect projection or a perfect type of measurement to um, to see if we can do profitability, because we learned that revenues minus expenses allows you to see if your company is generating enough revenue that covers all of your costs to see if you are a profitable type of business. Okay, so that is exactly why they close out at the end of a given period, right? It doesn't have to be every month. It could be every week. It could be every day. It could be every 3 months, or even at the end of the year. As long as it's some kind of way that we can use to measure ourselves profitability, but not only that, but to see to compare the profitability months, right? To see if the business is doing well. So that's why these are considered temporary accounts, because they do close at the end of the given period. Your revenues and your expenses are never going to reflect the same at the end of a given period. So if you have the month, right? Every month, your revenues will be different. You'll have new customers, old customers, the same exact customers that order the same thing. And then you have your expenses that can vary based on the month, whether you have a holiday, a sale, etc., etc. Okay, so that's how we understand these 5 types of accounts. And each one, I'm going to break down each one after this. But yes, so each account is there are a total of 5 accounts, and they're broken down even further by permanent accounts and temporary accounts. Okay, so excuse me. So the next part I want to talk about is going to be considered how we organize our chart of accounts. Now here we see here is a main account, a sub account, and a contra account. Okay, how these accounts work is that, so we have the main account, right? Or I'm sorry, we have the type of account, whether it's an asset, liability, or equity. All right. Now, each account type is going to be broken down into specific categories. All right. Or even better, like specific accounts that fall under those categories, which we'll talk about in a second. But how we understand it is that, think of it like a book, right? You open it up, the table of contents is going to give you the main chapter, and underneath it is going to be the lessons that you're going to be learning. All right, so that's exactly essentially the same thing as here, is that your main account will be the chapter, and then your sub account will be the lessons that you're going to be learning. All right, now here's a few rules and guidelines based on those ideas, right? So the main account usually functions as like an umbrella organization. It's like a general broad type of an account. All right, so for example, right, we have cash, we have inventory as the main account, But as a business, right, if we hold inventory is something that we use to sell a product. Do we just sell inventory? And that's where you can break it down even further by creating sub accounts, which give the main account more detail. So a sub account would be, well, I sell coffee mugs, which is considered inventory, but I'm breaking it down even further by saying I sell a specific inventory item. All right. So that's what the sub account it does for the main account. The sub account breaks down the main account even further. All right. And here's a concept that you need to know. These accounts flow in a specific way. When we learn about the accounting model, we understand that if assets flow on the debit side, either you're more likely to have assets increase, then the main account and the sub account flow in that direction. Okay, they are increased by a debit, so they typically would have some kind of debit balance. All right. However, we also have a contra account, right? Contra, we all know, right, is a preface that is used, right? We use controversy, right? It means opposite. Okay, so same thing idea here. This is called a contra account. You can have a contra account either give more details either to the main or sub account. And what the only unique thing about a contra account is it flows in the opposite direction. Hence the word contra account. So if this case, if my assets typically are debit accounts, a contra account would flow in the opposite direction, making it a credit account, right? Now, when we look at the accounting model, every account type is going to have a specific flow of direction, right? Whether it's debits or credits. That's how we understand accounting, is that we understand it as directions. Are we debiting an account or are we crediting an account? So that is the rundown on how you can determine when you build your chart of accounts, which is a list of all of your accounts, which we'll talk about in chapter 3. It's a list of all of your accounts, and they're broken down into specific criterias, or broken down by items, specific items that you either sell, that you need an account for to separate your cash, etc., etc. Okay, so here again, main account is like the chapter, the overall chapter. The sub account is what you're what the lesson that you're learning, and the contra account can be either or. It could act as a sub account. It could act as a main account. However, it flows in the opposite direction. All right? All right. This will make more sense when we look at our accounting model. Okay. All right. So here, we need to understand that when we look at accounting, we're looking accounting in terms of debits and credits. Okay? Most cases, we prefer debits and credits as left or right. Okay? The reason why we refer to it is because when we look at our general journal, you're going to notice that the general journal is going to be like a spreadsheet, right? And you have a column on the left for debits, and you have a column on the right for credits. For every single transaction, you can use either or a debit or a credit. Now, it really depends on what accounts you're looking at. So, especially, account types. Okay, if it's an asset, right? You're gonna learn that debits increase your assets. However, if you're looking at liabilities, you're gonna learn that credits increase liabilities. So never refer debits and credits as increase or decrease, right? However, when we look at a specific given context, whether we're looking at a specific account type, then you'll understand, well, what side usually increases the account, right? So debits may increase one account, but it could also decrease another account, right? So I want you to understand that debit and credit means left or right, okay? It means literally left or right, okay? Because when we determine what kind of account types we're looking at, is going to determine whether we increase the account or decrease the account, okay? So then we also going to talk about the accounting model. This is the backbone of all businesses, all right? The very main goal of doing business is to make sure that everything you own is equivalent to everything that you owe as well as the value of your company, right? If you didn't owe any money, therefore your assets is going to equal the value of your company. And it's true, right? If you own all these items, then the value of your company is going to equal everything that you own, right? Because you own everything. Now, of course, this equation can be interchangeable, right? You can look at it as equity is equal to assets minus liabilities. However, this is the most formal one because this is important to the balance sheet, which we'll take a look at in chapter 13, where we must solve and make sure that our assets do in fact equal our liabilities plus our equity. Okay? So here, no matter where we are at any given point in our accounting cycle, which we'll talk about, this equation must hold true. And if it's imbalanced, then you have a discrepancy somewhere and you must locate where it is, because this equation must hold true at all times. Okay? Your assets must always equal your liabilities plus your equity. All right? Excuse me. Okay. Any questions so far?
No, not from me.
No.
Okay. Right? So now we're going to go ahead and dive into each and every single account. So we're going to start off with assets first, okay? The definition of an asset is anything that you own, all right? Whether it is tangible, whether it's intangible, something you can't touch. It's basically anything that you have ownership to or property to, right? You own it. It's yours, okay? And how we determine how we sort out our information is going to be based on these three categories, right? And how so you have your current assets, you have your fixed assets, and you're going to also have other assets. Now, how we view or create these accounts and categorize them is based on how liquid they are. So we're focusing on liquidity. How easily is it available or readily available in cash form, which is the easiest form to exchange for goods and services. So that idea is going to apply here as well, that when we're looking at liquidity, right, cash is always going to be number one. Why? Because it's already in its liquid form, right? Inventory, right, can be quickly converted to cash because all you have to do is simply sell the product out. Okay? So current assets are going to be things that can be quickly converted into cash. Right? So I gave you a few examples there. All right? Now that we have our fixed assets fixed assets, also known as property, plant, and equipment, PP&E, right? That's corporate terms. If you understand PP&E, anything that's a property, so the land is your property. Your plant is going to be your building and everything that's in the building. So your desk, your lamps, your refrigerator, anything appliances that belong inside the plant or inside the building is going to be considered your plant. And then of course equipment is going to be anything that helps your business operate, like machinery. So those are where appliances actually fall under, is under equipment. Okay? That's how we determine it is a fixed asset. A good notion of a fixed asset would be that it's tangible and usually have some kind of life to it. Now, if we look at appliances, right, we know that appliances should give us some kind of lifespan, right? They can last 1 year, they can last 5 years. All right, so that's a key determining factor of how we categorize our fixed assets, is that it's based on those three criteria, right? It is either a property, a plant, or an equipment. Okay, now think of it this way. Since we're organizing it based on how quickly easy it is to convert to cash, right? Think of it this way. If I have furniture, right? How quickly is it possible for me to sell that furniture?
Can you repeat that?
Okay, so if I have furniture, which is part of my plant, right? It's something that belongs in my building. How quickly can I convert that into cash?
How quickly can you convert the furniture into cash?
Correct.
Convert it. What you mean on the books
Not
or
in the books, just
sell
like,
it?
yeah, selling it. How can
How
I receive
quickly?
cash? Uh-huh.
Oh, I don't know. Depends on your advertising, how the price, who's gonna be buying it. I don't know. How quickly can you sell it?
Exactly. And that proves the point why it's in a separate category, because okay, so what I mean by furniture is that we purchase it so then people can sit on it, or people can, let's say if we're or, for the workers to lounge on. Okay? That's
Okay.
what I mean by that. We're not selling the furniture, like we're not a furniture
Oh,
store.
right.
So in this case, you're right. That's exactly right. Because
Okay.
one, if we have it used, right, we got to do marketing. We got to place it on a platform, right? Maybe we sell it on Facebook or we sell it on Amazon, right? We have to do marketing. The customer who wants to buy it may have to go see the couch because it may be damaged because it's been used. They have to look at the couch before they buy it. And if they like it, then they'll buy it. But if they don't, then you have to move on to the next customer who's willing to buy it. Therefore, there's a chain of reaction and it takes a long time to sell it. Same thing with if you have a building, right? You got to put it on, you got to put it into escrow, right? Or put it on the market. Potential buyers need to look at it. Then you go into escrow. Then once you go into escrow, you have to file all these paperworks. You got to check your background score, and so does the customer. Then you have to go through 6 months of escrow to finally close out the deal, and then you can transfer the ownership of the building over. So it could take anywhere from, 1 week to 6 months or even a whole year to sell a specific item. So that's why we consider this as a fixed asset, is because it's not easily converted into cash. It takes time. Okay? So that's why we categorize it as a separate idea. And usually they fall right under your current assets. Okay? Then we have other assets. Other assets will be considered things that are intangible. That's a key feature. It's an intangible asset, as in you cannot touch it. So, for example, okay, an intangible item would be prepaid rent. You made a payment to your landlord to, for advance services for rent, right? You paid them 3 months in advance for rent. Now, let's take the idea on how to quickly convert into cash. Can you convert it into cash quickly?
No, still on.
Especially if it's rent and it's your landlord. You may have to go to court to get that money back. Okay? And you never know. Court can take up to a year, 2 years, 3 years, even you may never resolve it. So at that point, that is why it's at the very bottom of everything. Now, let's talk about intangibility. Can you actually touch rent? Can you physically touch rent?
No.
No. You can't. It's a service, right? You can touch the piece of paper, your contract, but if you tear that contract, right, essentially, your rent disappears like that. Okay? So that's why it's called an intangible. So we'll look at patents, copyrights, things you can't touch an invisible field that protects your idea. You can't touch it. That's a legal thing that you have to go through. Right? People can still touch your idea, but then again, an idea is also intangible as well. Okay? So that's why it's considered another asset, and it's usually at the very bottom of your assets when you categorize it. Okay? So usually when you have a chart of accounts, it should look exactly like this. You'll have it based on account type, which is my assets, and you're going to categorize them based on how quickly you can convert them into cash. So your current assets are going to be first, so always cash is number one. Then your fixed assets are going to come after, so anything that you own, whether it's a property, plant, or equipment. And then anything that's intangible is going to be listed last in your account for assets. So assets only have 3 categories: current, fixed, and other. All right, any questions here?
No.
Okay. Now we're going to talk about liabilities. Now we need to understand, okay, in accounting, we don't view liabilities as debt, okay? It's considered an obligation to us. But in the real world, right, when you owe people money, right, that's considered debt. You owe debt to somebody. You're in debt to somebody, right? But in accounting, we understand it as it's an obligation. We are obligated to make payments to them. We are obligated to owe them money. It's an obligation that we must pay. All right? So in accounting, we learn liabilities is equal to obligations. Now, again, we talk about what liabilities are. It's everything that we owe. O-W-E. Okay? Owe. As in, it's not our money, right? We owe them money. Okay? So how we categorize this is it falls under 2 categories: current and long term. All right? Not short term and long term, not current and whatever opposite is current. It is current and long term. Now, what these are going to be entailing is basically the time and length that you owe a person. Okay? So my current liabilities are going to be when we owe somebody for less than a year. Okay? So most cases, if you are going to look at a vendor to customer relationship that we're purchasing inventory from somebody, usually you have the minimum of 30, 60, 90 days to pay off a bill. Now, especially when you have services completed, usually they'll send you a bill and they'll tell you, well, you have 30 days to pay this off. Okay? So that's exactly why those would be considered a current liabilities, because you owe them for less than a year for whatever item that you purchase, whether it's you purchased it on an account for purchasing of inventory, or whether you acquired a service from a contractor. All of those are going to be considered current liabilities because you owe them for a short period of time. Okay? So again, we're going to be looking at accounts payable. Anything that we place on an account, whether it's purchasing inventory and we say we want to place it on an account, that's where we have an accounts payable. So you think about it in retail terms, right? In real world, that is where you go to any store and you open an account with them and they give you either a store credit card for you to use. That is exactly what this is, an accounts payable, right? You have an account with them, you open an account with them, they give you a store credit card, and all you're doing is just, swiping, and then they'll give you 30 days to pay it off, all right? Unless you finance with them, okay? Now, things that are typically things that you would owe less than a year would be when you collect sales tax, right? So we'll talk about this in chapter 5. I will more for chapter 6, for sales. But when we deal with sales, right, we have to collect money from our customers. But that money isn't ours. It's what we owe the government. Now, usually, the government's not going to let you owe them for more than a year. They're going to go after your money as soon as possible. So that's exactly why that's a good example of a current liability. You don't own that money. That money is something that you owe to the government for doing business. That's your virtual agreement that if you are going to be selling a product, you must charge sales tax, and that money goes to the state/local government. Okay? Now, what a long-term liability is anything that you owe for more than a year. So typical one that you'll definitely see is a loan, right? A business loan, a mortgage loan, whatever it is, usually they are definitely more than a year, especially for consumer loans. They don't expect you to pay right away. They expect you to pay over the course of 3 to even 5 years. Home loans can go up from 1 to 30 years, right? Minimum is 30 to 36 years, okay? So those kind of loans, right, are going to be something that you pay over a year, or it will take you years to pay off. You owe them for more than a year, okay? Whatever kind of financing agreements that you guys create or agreement you signed on, so whether it's a 36-year contract with 6% APR, that's your contractual agreement, and that's what you said. I'm going to owe you for 36 years, and I will slowly pay you back every single month. So that idea is going to allow you to categorize it as a long-term liability. Okay? Now, most cases in business, you won't see long-term liabilities anything more than just a loan. Okay? Everything else is most likely going to fall under a current liability. Okay? Any questions about liabilities?
No.
All right. Right? Equity. All right? Equity is going to be the value of your company. So you can also think of it as your net worth. What is your company worth right now? What's the value of it? Okay, and that is determine your equity. Now, when you go learn about corporate, okay, you're gonna learn that equity comprises of your income and your expenses. Okay, but here in private accounting or financial accounting, there's more to equity than just your income and your revenues. Okay, there's other factors such as capital contributions, owner's withdrawal. Okay, now what these things are is they're not categories. Okay, because equity does not have any categories. But as you progress through upper levels of accounting, you will learn that there are actual categories under equity, right? You'll have retained earnings. You'll have capital contributions. Or I'm sorry, not capital contributions. You'll have um, a, capital stock, right? But once again, I'm not teaching you advanced accounting. I'm teaching you the basics of accounting. And here we learned that there are no categories when it comes to equity. Okay? However, these items here are what influence how you determine the value of your company. So a capital contribution is going to be your original investment or any extra investments that you add to the company. So if you're placing more money into your company, right, your own money, that's you investing in your own company, and that's going to increase the value of your company, right? You have more cash flow, that means you're going to increase your equity, which allows you to make purchases of more furniture and etc., or more assets. Okay. Things that also decrease equity would be your owner's withdrawal. Since we understand that you and the business are one, therefore, if you have the capability to add your own money to the company, you also have the capability to take away money from your company. So, therefore, we have owner's withdrawal. And if you take away money from your company, you're going to potentially make your company lose value. Okay? And then, of course, the reason why this is the income is a contributing factor is that if you do have a profit, right, you can reinvest into your company. So add those profits into your company and increase your equity. But if you have a net loss, it's actually gonna force your company to lose value because you took a loss. All right. So now we kind of see the connectivity between the equity is that it is a part of why we have our revenues and our expenses, because it is potentially a contributing factor of equity, right? But we can choose what we want to do with our profits, whether we want to pocket it into our pocket or we could choose to reinvest into our company. So that's why I had it like this, that equity is going to be these two key factors plus your income. Okay? So, any questions about equity? There are no categories. I will be testing you on this particular thing, and if you answer, it's one of these two up here, I'm just going to have to just say it one more time. There are no categories, okay? Any questions about equity?
Can you said there's no
Cat
categories?
categories, correct. They only have sub accounts or main accounts in this case. Okay. All right. So now that we mentioned about income, which is your revenues minus your expenses, let's go ahead and break those two account types down. So income, right? You can refer revenues and income, they're both the same thing, right? In this case, I'm using income as if this is your profit, right? That's your net income, not your net loss. So in this case, your income is going to consist of all of your earnings minus all of your expenses. Okay, so we're going to break down your revenues first. So you can interchangeably use revenues or income. They mean the same thing, but when we move into QuickBooks, you're going to refer your revenues as income. Now, what
Wait. You said when we move into QuickBooks, you're gonna what?
you're going to learn that
Oh,
revenues is going to be used as income. Like you learn it as income. You can't interchange it there. Okay, but
okay. So your revenue is what you earn after you basically have sold things or accumulated your funds, right?
correct. It's your
So,
means of when you run your main core operations, it's
mhm,
your money that you generate. Yes.
okay. So, you say when we go into what was that revenues? No, when we go into expenses,
To QuickBooks,
into QuickBooks. I'm sorry. You said when we go into QuickBooks, what?
you will learn that revenues is known as income.
Oh, okay.
Yes,
All
because
right.
the terminology here are
Mm-hmm.
interchangeable. So you can refer it to revenues or you can refer it as income. They mean the same exact thing.
Okay. All
All
right.
right?
I got
That's what I
it.
was trying to get at. Yes.
Okay, I got it. Thank you.
Mm-hmm. So, but here, it doesn't matter what I use it as income or revenues. They mean the same thing. All right? In accounting. So your revenues is going to be anything that you generate for your company. So generating money. All right. Now there are two categories. All right. You have your operating income or operating revenues, right? This is when you generate money through the main core operations of your business. So once again, we're taking a look at as a merchandising type of company. So our main core of generating income is going to be sales. Okay? Because we're looking at buying items and selling it right back out to our customers. So sales is our main core operations for the business. Okay? Then we have other income, or it's also could be known as non-operating income, because these two other types of categories are going to be anything that you generate revenue that is not part of your actual core business. So if I'm selling a product, right, and let's say I charge my customers for delivery. Delivery charges is not my main core operations. I'm not selling my product to serve as a delivery truck service. No, I'm selling my product because I'm selling a product. So therefore, the delivery charge is going to be something that I generate revenue other than sales. Okay, I'm not selling my truck services. I'm selling a product. Okay, other determining factors for other income is if you invest in another company and you use that money to be part of your generated income. So investing in other companies, such as if you partner up with a company for temporary, right? So whatever earnings that that company makes, it will go towards your business. Maybe you integrated, maybe you guys are partnered on a product. You sell a specific product, but or collaborated, right? Therefore, whatever profits or income that you generate from stocks, right, is going to increase your revenues, but your main core of operations isn't involving in stocks. It just so happens that because you invested into another company, that you're putting that money towards your revenues. Okay, so a lot of vertical integration usually does this. Vertical meaning like it's one company that does multiple services. Okay, so here is exactly a good example of if you invest in some other company, whether you're partnered with them, and you generate revenue through their stocks, and you use it towards your business. That's going to be considered non-operating or other income, because that isn't what you actually normally do for your own company. Your main company does sales. Okay. Now, once we look at that, then we have your expenses. So you have three categories. Okay, you have your cost of goods sold, all right, which is directly correlated to selling your inventory items. Okay, cost of goods sold is directly correlated to the sale of your inventory. Okay. So again, expenses are anything that you have to spend, use, or spend, use, or it costs you expense. In other ways, in order for you to run your business. So if you are in the business of making sales, which we are looking at a merchandising company, cost of goods sold is your number one category here, because your intentions is you're purchasing inventory and you're selling them. So you will need a cost of goods sold. Pretty straightforward, right? What did it cost you to sell your goods? Okay. And then after that is going to be your operating expenses. So good examples of operating expenses would be, how did you run, what expenses did you have to incur to open up your business, right? If you had to pay rent, right, to have your store up and go and open the doors and have your customers come in and purchase the product from you, then you're going to incur rent expense. You need to have a building for you to supply all of your products, for you to sell your items, okay? Purchase expense when you purchase inventory, okay? Advertising expense is going to be considered operating, right? They're directly correlated to your main core of operations, okay? Usually a good determining factor would be anything that's in the facility or in the building is what's going to be considered operating expenses, okay? And then we have one more, which is non-operating expenses. This is going to be more for advanced level of accounting, all right? But I'm not going to stray you away from it, because it does exist. But non-operating expenses usually entails with like larger companies, right? A good example is if you you have your main building, but you own a storage or a warehouse off the side of the road, and you have to pay for its expenses to, maybe you need to pay security expenses to keep your items secure at the warehouse or facility. Maybe you need to pay for electricity to keep the room temperature control. Okay, maybe you might need to pay to rent out that warehouse, that facility. That isn't your main core of your job. Your job isn't, or the company isn't, the main core of the operation of the company isn't to protect assets. It's to sell those assets. So that's why it's going to be considered non-operating. All right. Now, of course, once again, that's going to be considered more advanced level of accounting. So if you do seek further, if you go into cost accounting, you're going to see there's selling and admin expenses, fixed expenses that are non-operating. Okay, so once again, non-operating exists, but for this course, I'm not going to teach you anything that has to do with non-operating expenses. So there's nothing that will have a scenario for that has non-operating expenses. I just wanted to let you know it does exist. Okay. Any questions between revenues and expenses?
No.
All right. So here is going to be the accounting model. This is definitely something that you should print out. I believe your readings has the exact accounting model page. It should be page 5 or 2 or something like that in chapter 2, where you see the arrows going up and down. This is going to be the accounting model. Now, how the accounting model works is this is the determining factor of how a business transaction works. This is how you determine how it flows in the accounting world. Okay, so in this case, we refer these as a normal balance. All right, so this is going back to the main account, and the sub account, and the contra account, right? So here we looked at an asset, right? The normal balance determines on which side increases on the positive side. So in this case, my assets, right? Debits increase my assets. Okay, so that's considered the normal balance of this. So for the main account, if its normal balance is increased with a debit, then we can understand that the contra account is going to be decreased by a credit. Okay, this also functions in understanding how a business transaction works. If I sold an item, so I had sales, right? Therefore, I increased my account by a credit, but I also received some form of money, some form of cash. So in order to do that, I've also increased my assets, okay, because I received money, okay, and money is the first asset that you have, okay. Another example will be, let's say I decided to owe money, right? If I owe money, that's a liability, right? So therefore, I'm going to increase it on the credit side, all right? Now, let's say I want to pay off that liability, right? If I want to use my own cash to pay off that liability, I'm going to decrease my liability because I don't owe it anymore. But at the same time, I had to use money to pay off that liability. So therefore, I had to decrease my assets because I am no longer having that cash in my hands. I'm getting rid of it. I'm spending it in order to decrease my liability, to not no longer owe money anymore. All right? So this also comes into the factor when we understand when we use debits and credits, right? You can't use that as increase or decrease because it depends on the account type that we're looking at. Assets, debits increase, credits decrease. Liabilities, credits increase, debits decrease. All right, so that's why we refer debits and credits as left and right, not increase or decrease, because you have to look at in context. What account type are you looking at in order to determine whether an account increases or decreases? So this page here is going to be the key kind of worksheet, cheat sheet that you should have to understand how a flow of a transaction, of a business transaction actually works. What does it, are we increasing our cash flow or are we decreasing our cash flow, right? Are we increasing our what we owe to a person or are we decreasing to what we owe a person? Are we increasing our sales or are we decreasing our sales, right? Did we encounter any expenses or are we decreasing our expenses? Okay, so here is the accounting model. Okay, very, very important thing that you should know. Okay, now here we could see that some of the arrows point up and some of the arrows point down. Now, a good way to kind of memorize this is that your assets and your expenses will normally have a debit balance. Everything other is going to have a credit balance. Okay, so as long as you can just determine that your assets and your expenses are going to flow in the same direction, then out of the other 5 accounts that you should know, right, there's only 5 and 5 only, your liabilities, equity, and your revenues are going to have the opposite effect, right? As in, the debits will decrease and the credits will increase. The opposite motion here, all right? So, this, once again, will make more sense as we go down and start practicing journalizing our transactions and understanding how the flow of it works. Right? Question?
I think you answered it. You said as we go further, we'll understand more better.
Correct.
Okay.
Okay? So once again, we have 5 categories: assets, liabilities, equity, revenues, and expenses. I'm sorry, account types. Okay? And each one has a specific normal balance. Okay? So again, the normal balance is the side that increases. Okay? On the positive side. Okay? So it increases on the positive side on each account. So your assets will normally have a debit balance and your expenses would normally have a debit balance because it increases on that side. Everywhere else has a normal credit balance. And this will come together when we dive into our fictitious business, when we do a running balance or a ledger account. Okay? All right? Now, we're going to take a look at a bookkeeping system. All right? There are 2 bookkeeping systems. You have single entry and then you have double entry. Now, how we understand this is that, well, for a single entry, you only are recording it one way. You're only using one account and you're only reflecting one side of the transaction. So a good example of this would be your checkbook, right? When you have a checkbook, you write your check out, and at the very top of your checkbook, you should have this little register account that allows you to record that you wrote a check out. Okay? Now, that only shows one direction of the transaction. It just shows that money is leaving your account. Or in this case, you're spending money for something, right? It doesn't determine what that other account is doing. For example, if I'm paying for something, what am I paying for? I don't know, because if I'm using a single entry system, I only know that money is leaving my bank account. Okay? Where if I look at a double entry system, right? This is where I record 2 directions. So I'm using 2 or more accounts. And the idea is that when I am making a payment, if I'm paying a liability, then I'm going to record that as well. So I have an equal and opposite transaction. So we do a little science in here, right? If you have an action, you're going to have an equal and opposite reaction. Okay? So this is where, if I'm going to record a transaction, this is where we're going to be using your debits and credit system. Okay? If I paid off a liability, then I'm going to record one line is going to be the flow of where my cash is and then what it does to my liability. So I'm recording two or more accounts to reflect that a transaction has happened. Okay? And by doing so, I need to use the debit and credit system. And for accounting, you will be using the double entry system because in this case, we can see where our transaction goes at the end of the day, right? If I'm spending money, where am I spending money to? Oh, I'm spending money towards my liabilities because I'm paying it off. Or I'm spending money for an expense to incur. All right? So here I'm tackling more than one account. Okay? Now, that's just an example. You can do an asset, you can trade an asset for an asset, right? I can buy inventory, right? Because cash is my asset. Inventory is also an asset. I can trade an asset for an asset. Yes. So that's what's this here is telling you that you're going to do. You're going to be involving more than one account at one given time, where single entry only allows you to tap into one. All right. So that's this here. And one key notion is that when we do journalize, all of your debits must equal all of your credits. Okay, that is the number one rule, right? That's the idea where if I have an equal action, I need to have an equal and opposite reaction. So for whatever amount of debits I encounter, I need to have the equal credit. Okay? So this will make a lot more sense when we dive into chapter 3, because chapter 3, we're going to take a look at how to use the double entry system. Right? Any questions here?
Can you repeat that, please?
Which one? Okay, so when we're looking at a double entry system, okay, so in chapter 3, we're going to learn about how to journalize, right? That's how we're going to take a look at how we compute our debits and credits, right? We're going to be dipping into multiple accounts, and we're going to see that at the end of the journal, your debits must equal the total amount of credits.
Oh, okay. I'm sorry. I thought you said something else. Thank you.
No worries. So once again, every action is going to have an equal and opposite reaction. Okay, so if you have $10,000 of debits, you need to have an equal and opposite $10,000 credit somewhere. Okay? Right? And you're not limited to just only one account. You can have 4 or 5 accounts as long as you're distributing your total amount of debits across the total amount of credits amongst those accounts. Okay? Double entry system. Okay? So here we are, course review. So things that we got to take a look at is what the definition of the accounting is. All right. Here is a little overview of the accounting model as well as the accounting equation right above. Okay. Here's we refer debits and credits as left and right. The definition of a normal balance. Okay. And then here are the categories of each account type, right? So each one is broken down into each one. Now notice this, equity in capitals, letters, says has no categories, okay? Make sure that you guys are aware of this, okay?
Got it.
Okay. So there we have it, course review, our temporary accounts and our permanent accounts. The permanent accounts, obviously, they do not ever close, but your temporary do. All right. Any questions in regards to chapter 2?
No.
Okay. So as
To
we
me,
go ahead.
I'm sorry. To me, it's kind of confusing because I'm more of a visual person, and I do appreciate the slides, but unless I see like an example,
Mhm.
it's gonna make more sense. I just want you to be aware of that.
Oh, of course. You're welcome. So once again, all of this is just general information because as we move down and learn each section, right, the sales process, payroll, inventory, when we learn all of that, all of this stuff that we're learning right now, chapters 1, chapters 2, chapters 3, they're all going to kind of piece together and they're going to slowly make sense. Okay? You don't need to understand it now, but as we progress through the lesson, it will come together at the very end. So by week 15, you should kind of get an idea of what accounting is by then, right? I'm not expecting you to know it now. I'm expected to at least have some kind of idea by the end of the 15th week. Okay? So, any other questions in regards to chapter 2? All right. Let's go ahead and dive right into the exercises. Okay? So, number 1, okay? What are the 5 types of accounts?
Uh,
Go ahead.
oh, here's Sonia.
Assets,
Assets,
Liability.
liabilities,
liabilities,
Equity,
and
revenue.
An expense.
okay, right. Once again, you can refer revenues as income. Oops, income
Expense.
Yep.
and expenses. Yes. Good. Right. What is a main account?
it's a general account,
Say that again.
odd or general account, like
Okay.
cash.
Good. General account. What? Well, okay. What specifically makes it unique?
I wrote down the actual definition on the book. It says accounts that make up a list in a certain type of an account.
Good. Okay. So general account. Uh. Okay. Makes up a list of a type of account. But what general direction does it flow in? Actually, I just gave you the answer. That generally flows in a specific direction. Okay? In other words, it flows either on the debit side or the credit side. Okay? So then, what makes a contra account? What is a contra account?
Direction of a main account.
Say that again. What was that?
I know it flows in the opposite direction of a
Good.
main.
Good. Okay, so main or sub account. It's that one you can use it anywhere. Okay? Now, it flows in the opposite direction. Okay, that's good. I guess that's good enough. But it also, I guess you could also say to it that it also gives the main or sub account more detail. Okay, so we remember, if you guys remember, the main account is like the general overall chapter, right? The sub account is going to be the lessons that you learn under that main account. So it's going to give the main account a little more details. So for example, remember that inventory? You can sell inventory, but if I want to be more specific, I would say I would sell coffee mugs. So that's how you understand that. Then of course a contra account is just going to flow in the opposite direction, but it does give the main or sub account more detail. Okay. All right. So what does left mean?
Left is a
Debit.
debit
Okay. What was that?
and right is the credit.
Good. Right. What does account? What is the accounting equation?
Assets equals liabilities plus equity, always.
Yes, assets must always equal your liabilities plus your equity. Okay. In this case, I'm gonna use equity as plain. If you have owner's equity, good. Right. All right. What are the three categories of assets?
Current assets,
Mm-hmm.
Fixed assets.
Fixed. Good.
How about intangible assets?
Okay, what's the intangible assets, okay.
Other
What was that, Nathan?
asset.
There you go. Other assets. Other assets is going to be the category, but a determining factor would be intangible assets. Yes. Okay. All right. What are the two categories of liabilities?
Current and long-term.
Yes, current and long term. Okay. What are the categories of equity?
categories.
No categories. Good. Okay, categories. Okay, no categories. Okay. What are the categories of expenses?
But the operating expense.
We got operating,
Non-operating.
non-operating.
And cost of goods sold.
Yes. And cost of goods sold, also known as COGS. Okay. All right, and then what are the categories of revenues / income?
Or in non-operating.
Okay, okay, operating, and the other one is other / non-operating. Good. Number 12. What are the two accounting systems?
Single and double entry.
Yes, single entry and double entry. Okay. And then last but not least, what is the normal balance?
Debits must equal credits.
Mm,
Not right.
no, not really.
Positive balance found in a specific account.
Yes, positive balance, or in this case, I actually want you to refer it as the side that it increases on. Okay? Because pen positive can be also interchangeable as well. It doesn't really tell you the exact direction per se. So I'd rather have you guys refer it as
The increase
the
on a
side.
specific note.
Good, exactly. The side that increases in a specific account. Okay. Good. Right? All right. So for this question here, I have a list of a bunch of accounts that I would like for you guys to practice. So question 14 is going to be is going to be a list of a couple of accounts that we have. What I'm going to have you guys practice is determining the account type, the category it belongs to, and what the normal balance is. So does it have a normal balance on the debit side, or does it have a normal balance on the credit side? So that's what this exercise is going to be. So this is testing your memory here that you need to have to know your 5 account types, and you need to know what specific categories belong to them. Okay. So here, for example, our first example here is a checking account. Your checking account is going to be money in the bank. So what type of account would that typically be?
That would be an asset.
That would be an asset. So here I'm going to use,
A.
yes, I'm going to use abbreviations. If you look above, it kind of gives you what they are, but for the answer sheet, I actually write out the answers. So A for asset. Yes, it is an asset. But what kind of asset?
Is it current?
Current. Yes, because what is money into the bank to you? Isn't that cash already readily available?
Yeah.
Yes. So that's what determines it to be a current asset. Now, what normal balance would this asset have?
A positive balance?
Okay, positive in which side? Left or right?
Right.
Right.
Not the right side. That's credit.
It's a debit side, right?
Debit side.
Oh, it have a positive balance on the debit side?
Correct. So go ahead and pull out your accounting model. The
Oh, what?
sheet, the accounting model, the sheet that has
Oh, okay.
your little arrows on them. Okay? If you have this, it's going to determine to you what the normal balance is. Okay? All right? Okay? So it would normally increase on the debit side. Okay? What about an accounts payable? It's money that you owe to vendors.
That would be liability.
Liability.
It will definitely be a liability. Now, what kind of liability?
Not like,
It's not long term.
If it's not long
It is?
term, no, if it's not long term, then what is it?
short-term borrowing.
Current. Okay. Okay, so in this case, there's only 2 categories for liabilities, right? Current and long term. If it's not long term, right? Because in this case, you're
Oh.
owing to vendors, right? Do you think a vendor is going to allow you to owe them for more than a year?
No.
Probably not. Probably not. And if they did, then they must really like you. All right, but if not, most cases, no. Vendor to customer relationship, usually the max they'll give you, maybe 120 days is probably the most. But most commonly, it's always 30, 60, 90. Now, for liabilities, what would be the normal balance?
It's the credit side,
It would increase with a credit. Good. All right. Next example. What about a copyright? It's a legal documentation of ownership of or right. Okay.
Equity.
Asset.
It is an asset. Now, what kind of asset?
The current asset.
It's not a current asset because,
Long term?
well, no, it's not a long-term asset. There is no such thing as a long-term asset.
Intangible.
Okay, you're getting warmer, Nathan. So what do we call those? There's another word we use for that. Where do we that's a feature of this category. All right, let's look above what your options are.
Operating.
That's not operating. Okay.
Would it be over?
Other, yes, because the key feature here is that you can't touch a copyright. It's intangible. And we would categorize our assets according to liquidity, right? But in this case, you can't, a feature of other assets is that you can't touch it. So in this case, it's going to fall under other. So one thing that's going to also help you too is if you're having trouble memorizing or remembering what those categories are, use this worksheet right here or this page right here, right? Because here I give you the exact account types and what those categories are. All right? All right. So here, what do we do with supplies? Supplies that are needed to operate the business. I'll also give you a hint here. Supplies. When you purchase supplies, who has...
We're missing on copyright.
Go ahead.
The normal balance. Are we gonna put anything?
Oh yeah, I'm sorry. Go ahead. What's the normal balance of a copyright or an asset in this case?
Other?
Okay, so normal balance is asking does it increase on the debit side or the credit side?
Oh, I thought you was on the last one.
The debit side.
It would normally increase on the debit side. Okay? If you think about it, when you acquire copyrights, can you decrease a copyright?
No.
You most likely would never, right? You could sell your copyright, but once again, most likely you're going to acquire it. Okay? All right. So going back to supplies. Okay. Now, when you purchase supplies in order to operate or to help run your business, right? Who has the ownership for those supplies?
The business, the owner.
Correct. So therefore, when you have supplies in order to operate the business, what would you actually...
Expenses.
Assets.
Assets, yes, because you're going to own those supplies. You would only use the expense when you've used those supplies. So that's a key factor there. So it is going to be considered an asset. Okay? Now, what kind of asset would you categorize supplies as?
Would it be fixed?
Well, let's look at the factors of a fixed asset. Is it considered property? Is it considered a plant?
Considered property.
Okay, so in this case, when I taught you what property means in a fixed asset, it's just basically the land, the streets, the sidewalks. It's the area. That's what I mean by property.
But not in equipment.
Equipment would be machinery, appliances. Would you consider supplies as machinery, appliances?
No.
No, you wouldn't. So a fixed asset is definitely not where supplies belong.
I'm gonna say current.
Yes.
No.
Okay. Current because one, if you make purchase of its supplies, you can go right back to the store and return them easily, as long as you don't open them, right? And you have the receipt. But another notion here is that supplies, right, when you own them, you're most likely to expense them quickly because you're using them in order to operate your business. So in this case, it would definitely be something that you can liquidate pretty quickly. So it is a current type of asset. Okay. Or if anything, if you have supplies that's already used, you could go ahead and be like, well, hey, I'll sell it to you for $1, right? Supplies are very easily to turn around and sell, whether it's to the public or whether it's to like someone in your office or something like that. You can go around and resell it and get money for it instantly, right? So in this case, it definitely is a current asset. Now, what kind of normal balance would this have?
I have a debit.
Yes, because it's an asset, it would normally have a debit balance. Okay, right? You're more likely to purchase supplies versus decrease the supplies. Okay. All right, what about loans? Loans, okay? Owning owning money to a bank over a period of time.
Liability.
It is
Liability.
It is 100% a liability, and typically, what are loans going to be?
A debt.
Yes, but in category wise, where would you place this?
No credit.
What was that, Nathan?
Credit.
Yes, it would be a credit balance. Yes, because you're owing money. Yes, it's a liability. But what kind of category would you determine this loan for?
Current.
Okay, so current is if you owe for less than a year.
Long term.
Long term.
Long term, because typically most loans that you do generally start off with would be technically more than a year, right? A lot of consumer loans out there or business loans easily are maximum or minimum 3 years, okay? Home loans are easily 25 to even 36 years, okay? So typically loans are more for the long term, okay? But yes, you can have a short term loan. It will actually say short term loan that you could borrow for 6 months. But once again, those kind of loans are not as common as long term loans. All right. What about an accounts receivable? When customers owing the company or the business money. So you sell a product and they place it on an account with you saying that they're gonna owe you the money. However, that's money that you have, right? Because it's essentially an IOU. So in this case, what would an accounts receivable be if customers owe you money? Okay? When a customer owes you money,
It's an asset.
it would be an asset. Yes, it would, because you can go and knock on the door and say, "I want my money back," or I want the money that you owe me," and you're more likely to, possibly get that money. So it's definitely something that is an asset. Okay, now
Yes.
what's kind of asset?
Short term.
Do we have a category called short term?
No, it's a current asset.
Current asset. Good, because when you again, when you sell a product, right, you have the option for them to either place it on a credit, so they owe you money, or they can actually give you cash for it. Okay, so we'll talk about that when we go into chapter 5. Chapter 5 and chapter 6. But in this case, right, the customer decided to put to owe us on an account, so it technically owe us money that we've earned, money that we own. Okay, so in this context, right, we own this person's money, but they haven't given it to us yet. So in this case, it's going to be considered a current asset, because we can go around and knock on their door and say, "Hey, I need you to pay up." Okay? So therefore, what kind of balance would this account have?
Asset, so it debit, right?
Yes, it's going to be a debit, right? Because you're more likely to increase accounts receivable, because if you're constantly making those sales and these customers are constantly owing you the money, you're more likely to increase your sales with that, or increase your earnings that way. Okay. What about an owner's withdrawal? Taking money out from the business.
That's equity.
It is an equity account. Good. So OE for owner's equity. Now, what kind of categories would it have?
You're saying, oh, the withdrawal decrease the account.
Yes, owner's withdrawal would decrease the account. So
But
look,
it
it
doesn't have any categories. Right?
no categories. Excellent. Okay. Now, here you pointed out a very good detail here. Owner's withdrawal would decrease an equity account. Okay? If you're looking at your accounting model, what would determine, or which side would determine you decreasing an equity account? What was that? Not a credit. Look at your accounting model.
That would be a debit, right?
It would be a debit. Correct.
Okay.
Yes. Okay. So if we looked at our accounting model once again, right, we see that for equity, right, it would increase with the credit side, right? But we're looking at something that decreases the account. So in this case, we're looking at the debit decreasing the equity account. Okay, good. All right. Next we have here is advertising expense, marketing for the business. That's 100% an expense, yes. Now what kind of expense? Say that again. Say that again. You said other. Do we have a category for other in under expenses?
Operating expense.
What was that?
Operating expense?
It would be 100% operating expense because here's the key notion. You're doing marketing for the business. Most likely, if you are a sales, right, you're going to market in order for you to generate your sales. So in this case, it is towards the operating portion of your business. So it is an operating expense. Now, what kind of balance would it normally have?
A debit?
It would have a debit balance. Yes, it would increase on the debit side. Okay. What about a cost of goods sold? The cost of the item that you sell.
Is it an asset?
Cost of goods sold.
Mm,
Operating expense.
It's an
operating
expense,
expense.
but it's not operating expense because what are the categories of expenses?
Yeah.
Oh, cost.
It is directly a cost of goods sold, yes. Okay. And yes, it's a debit. I heard that. So good. Because we recognize that our expenses would be increased with a debit, then yes, it will normally have a debit balance. Okay. What about inventory? Items that you purchase that you plan on selling.
Those are assets.
These are assets, correct. Now, what kind of assets?
Current.
Current assets, because once again, when we purchase inventory, we can easily go right out and sell it out to the public and generate that, cash. So in this case, what kind of balance would it normally have?
Credit?
Okay. Now, this is an asset. When you acquire your inventory, you would normally do what? It is a debit because
Increase.
you would more likely increase your assets by making the purchases of inventory.
Oh,
Yes, you would decrease it when you sell your inventory, but in this case, we're looking in this perspective of in order to have it as an asset, right? You need to purchase it. And then again, we're not looking at selling it, we're looking at acquiring it as an asset. Then yes, you would definitely debit the account. Okay. What about land, which is your property? It's an asset. Okay, go ahead. Fixed. Do you say fixed?
It's an asset.
It's an asset. But what kind of asset?
a fixed asset?
Yes, because it falls under that category property, plant, and equipment, right? Land is definitely part of the property. So, what kind of normal balance would you have?
Debit.
100%. You're more likely to acquire land versus sell land. 100%. Okay. What about sales? Let me see how many we have. Okay. What about sales? Okay. Sales is going to be earning money from selling a product or service.
Income or revenue.
Income or revenue. Good. So I believe you could do both. Okay. Good. Now, what kind of category would you place this?
Credit revenue.
You would credit revenues. Good. But what kind of Okay, do we have current revenues?
Yes, current.
We have that? I don't know.
Do we have current revenues?
No.
Those
No.
operating.
Operating. Okay, in this case, because we're looking at merchandising inventory or merchandising type of company, right? your main core operations is sales. So in this case, it is both operating
Oh,
income, or you can also treat it as just sales. Okay, because above here it says you have sales as an option. Okay. We did have sales for an option. I don't see it. Okay, I guess it is operating then. All right. So let's see here. What about capital contributions?
That's equity.
It is equity, yes. So OE for owner's equity. What kind of category would a capital contribution have or be under? No categories. Excellent. And this time, the capital contributions is investing money into the company.
Credit.
that would be a debit, wouldn't it?
That would increase that business. So
Okay. Now, let's take a look at our equity accounts. How would you increase your equity?
By selling more stuff.
Okay, so that's not what equity is. Equity is the value of your company.
Okay. So how would you increase it?
Correct. Like on the debit side or the credit side?
Oh, on the credit side?
Correct. Right? That's what the normal balance, that's what I'm asking you. When you look at the accounting model, what would the normal balance be? What the definition of the normal balance would be? What side does it increase on?
that's the question. It's confusing.
So I'm just asking you what the normal balance is. The definition of a normal balance is the side that which it increases on a specific account, right?
Okay.
So when I ask you what the normal balance is, you're gonna take a look at your accounting model here, and you're gonna look at each account type. Now, what side does the equity account normally increase on?
The credit side.
The credit side.
Yeah, on the credit.
Yes. Okay. So that's what that question is asking. It's like, what would the normal balance be? And it would normally increase on the positive side, which is on the credit side. Okay. Right? All right. So here we have equipment. So any machinery or object that to run the business or the organization.
Asset.
It's an asset. What kind of asset?
Operating.
Okay, I heard two answers.
A fixed asset.
It is
Fixed asset.
fixed asset for sure. Now, what would its normal balance be?
Debit.
It would have a debit balance. Good.
A debit, yeah.
Yes. Look at your accounting model, right? It usually would be increased, right? Especially when you purchase equipment, right? You're more likely to increase it because you're purchasing these equipment versus then selling it out. What about a notes payable? IOUs to other people.
Account payable.
That's a liability.
It's a liability. Now, what kind of liability? Okay, so I'm going to give you a little more details to what a notes payable is. It's, in other words, when you have an IOU, right?
Mhm.
You get to be flexible with the IOU, saying, well, hey, I'll pay you as much as I can now, but I can also defer my payments.
So long term debt.
It can be long term, but at the same time, it can be current too, because maybe your agreement was, I'll pay you within 6 months. But let's say the end of 6 months and you still owe a large amount of money, you can always renegotiate either an extension or deferment. And then therefore, your 6 months IOU can turn into a year worth or even a year and a half. You can always extend your time. So most when you finance a specific like when you have an account with other vendors, right? Or a store, for example, right? You have a credit card, right? You can extend that owing ability to as long as you like, as long as you end up paying it. But you're just going to have, interest tacked onto it because that's the cost of deferring a payment. Okay, so in this case, it can function as both current and long term. And what kind of normal balance would it usually have?
A debit?
Okay,
Or
let's,
credit.
it would normally increase on the credit side, right? When you owe people more money, you're more likely going to increase it on the credit side.
If you owe them money, isn't that a debit for the business?
Okay, so you have to look at who is, which side are you looking on? Are you looking at us as the company, or are you looking at as the business itself, like the other person's business? Because if you're looking at the other person's business, that's a debt, that's a debit to them. But for us, it's a credit because
It's a
we're
credit.
doing the owing,
Okay.
right? Yes, we're doing the owing. Okay. All right. So here, what about rent expense?
It's an expense,
Yes, it is. What kind of expense?
operating expense.
What kind of what kind?
Operating expenses,
Excellent, operating. And what would you normally see? Like, what? How does it normally increase on?
credit side,
Debit side?
Debit.
Debit side, yes. Okay. Expenses are always going to be on the debit side. Okay. What about delivery income? Okay. When you charge customers for to cover for delivery charges.
that's revenue.
It's a revenue, yes. Right? Because
Yeah,
you're earning money, right? But what
yeah,
kind of
other income.
Other income.
it be other? Good. Now, how would you increase a revenue?
On the credit side.
On the credit side. Good. Okay. Last but not least, purchase expense. Okay. Making purchases for the business operations or inventory items.
It's an expense,
It's an
Expense.
yes, for
Yes.
sure.
operating expense.
100% because this is an expense that you have to do for the business. There you go, operating. So then
Debit side.
it would
Okay.
be a debit side.
That's a debit.
Good. Okay. So this is just taking a look at a first example of what you would commonly see. Now this is practicing how to use the accounting model, but also making sure that you are aware of what your type of accounts are and what categories belong to them. So once again, oops, I hit the wrong one. When you are looking into this exact worksheet here for the review, this is your perfect guideline, your cheat sheet for you to have because I noticed that a lot of you guys were interchanging all these. You're saying there's a fixed liability, there's an operating asset. So make sure that you are aware of this right here that assets only have three categories: current, fixed, and other. All right. So each one have a specific amount of specific titles for categories. Okay. So make sure that you know those ones. Now the normal balance, once again, the definition is it on which side it increases on. Okay. So if you just look at it this way, my assets and my expenses will always increase with a debit. Always increase with a debit. Okay? But it depends on what account you're looking at too. If you're looking at a contra asset account, then you're going to determine that it's decreasing my asset. So therefore, it's going to be a credit balance. Okay. So once again, we won't go into contra accounts yet. In chapter 5 we will. But just that idea here is that just know that your assets and your expenses will always increase on the debit side. All right. Every other account, so your liabilities, your equity, and your revenues will always increase with a credit. Okay, so that's what the definition of a normal balance is. It's the side that it increases on. Okay, all right. So, once again, any questions for chapter 2?
No.
Can you again give me an example for the fixed asset that falls under plant?
Plant is going to be your building and anything that goes into it. So your lamps, your furniture, your desk. So it's your building and anything that's in your building. Okay? Furniture, lamps, desks, TVs, all of those are going to be considered things that belong into the plant.
Okay, thank you.
Mm-hmm. All right, so right now it is 10:20.